Hello friends, welcome to our channel. If you are worried about the potential impact of a recession on your personal and professional life, I've got you covered. In this video, I'll share some tips and strategies to help you overcome the fear and uncertainty that come with economic downturns. Don't let the fear of the 2023 recession hold you back. Learn how to turn it into an opportunity for wealth with these expert tips before you get carried away by the video. Immediately subscribe the channel and like the video. Our video can sometimes be a little long because we never compromise on the video content, so it's important to watch the video till the end. Number 1. The importance of having a financial backup plan. Based on current statistics, it is expected that unemployment levels will rise to 6.5% by 2024. If you are worried about losing your job, it is recommended that you create an emergency fund or a stockpile. An emergency fund is a cash reserve that is easily accessible and not tied up in the stock market or property. This can be a vital lifeline if you lose your job or experience a medical emergency. Coping with unexpected events can be financially stressful, especially when the cost of living is high. Therefore, having an emergency fund can give you peace of mind and ensure that you have enough money to make ends meet. The recommended amount for an emergency fund is 3 to 6 months of your basic living expenses if you are employed, and 6 months of your living expenses and 6 months of your business expenses if you are self-employed. In times of recession, businesses are particularly vulnerable. With rising inflation, people generally have less disposable income to spend, and this can have a knock-on impact on the profitability of businesses of all sizes. Therefore, having an emergency fund for your business is essential to ensure that you can sail through the rough times and stay afloat until you reach the other side. By having a financial cushion to fall back on, you can make sure that you and your business are well prepared for any financial challenges that may arise in the future. Number 2. Keep a level head during market downturns. If you find yourself in a situation where the stock market has dropped and is expected to continue dropping over the next few months, it is important not to panic and sell your investments. Even though it is difficult to see your investments decrease in value and turn red, selling and panic selling especially is not a wise move because it crystallizes your losses and removes any possibility for you to recover your money. This is a common mistake, even among experienced investors. However, it is important to remember that the stock market has always recovered from major crashes like the 1979 crash, the dot-com crash, the 2008 recession, and the 2020 crash. And the general trend of the stock market over the years has been an upward trajectory. Instead of panic selling, it is important to stay calm and focus on the long term. Remember that most fortunes are made during a recession. Make sure that you have an emergency fund and have paid off your debts before you invest. Once you have done this, you can start thinking about investment strategies, such as keeping your gross withdrawals as low as possible, withdrawing income tax efficiently, making sure you utilize any unused tax-free cash and unused personal allowances, and not crystallizing your losses by using drawdowns to take 25% of your pension. Ultimately, the most important thing to remember is that it's all about time in the market, not timing the market. Stay invested for the long term and don't let short-term fluctuations in the market cause you to make hasty decisions that could harm your portfolio. Number 3. Protect yourself from dangerous loans. As the global economy recovers, interest rates have been rising in many countries, making borrowing more expensive. This has led to a situation where paying off existing debts has become increasingly important for consumers. According to a recent article from the BBC, inflation rates in the UK have increased to 10.4% in the year to February, compared to 10.1% in January. In response, lenders have begun to raise interest rates on loans, mortgages, and credit cards. Financial experts are advising consumers to pay down their existing debt as soon as possible. The Guardian reports that even a small increase in interest rates can have a significant impact on monthly repayments. For example, a family with a £200,000 mortgage over 20 years, with a variable interest rate at 3.59%, would pay an additional £15 a month if the rate goes up by just 0.25%. There is also the likelihood of further interest rate hikes in the future, as central banks aim to return inflation to their 2% targets. A recent report from Your Money suggests that markets are expecting interest rates in the UK to increase to around 4.7% by mid-2023. Although there is a high degree of uncertainty around the path of future policy, in light of these developments, it is important for individuals to take action and pay down their debts as soon as possible. By doing so, they can save on the interest they would otherwise have to pay. This could involve paying off car loans, credit card debt, or furniture bought on finance. The sooner these debts are paid off, the greater the savings will be over time. Therefore, consumers should make it a priority to pay down their debts and avoid taking on new loans or credit cards until interest rates stabilize. Number 4. Income sources that are not affected by economic changes. The COVID-19 pandemic has highlighted the importance of having a diversified income, as unforeseen events can quickly disrupt entire industries, leaving those dependent on a single income stream vulnerable. While it is difficult to predict which industry will be affected next, history has shown that various industries can be vulnerable to sudden changes in the market. Having multiple income streams can make individuals more resilient and better able to weather financial storms. In addition to having diversified income streams, having an online business can provide a level of security during unexpected events like lockdowns or other disruptions. The COVID-19 pandemic has highlighted the importance of remote work and online businesses as people have had to adapt to new ways of conducting business. Investing is another area where diversification is crucial. Rather than investing everything into individual stocks, it is recommended to spread investments across different index funds and asset classes. This helps to reduce the risk of losing money due to the collapse of a single company or market. Number 5. Expand your knowledge base. During a recession, unemployment tends to rise as many businesses close down, making it harder to find a job. It is, therefore, a good idea to keep your CV updated and start networking as soon as possible. The saying that the best time to find a job is when you have a job is particularly true during a recession, as having a job gives you the ability to use your existing network and negotiation power. Other strategies for surviving and thriving during a recession include cutting back on expenses, saving money, and looking for opportunities to earn extra income. Additionally, investing in education or training to develop new skills can increase your chances of finding a job in a more stable industry. It is also important to remain positive and maintain a strong work ethic, as this can help you stand out to potential employers and improve your chances of being hired. Educate yourself, take action, and seizing the opportunity. You can navigate the challenges ahead and emerge stronger and more resilient than ever before. So don't let the fear hold you back. Go out there and make your dreams a reality. Thanks for watching. Don't forget to hit the like button, subscribe the channel and comment on the video. Thank you. We'll see you in the next video.